Welcome to Optimal Insights, your weekly source for timely market analysis and expert commentary from Optimal Blue. I'm your host, Jim Glennon, Vice President of Hedging and Trading Client Services at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keep the industry informed. Let's dive into today's episode. Hi, welcome. Hope everybody had a wonderful Thanksgiving last week. Welcome to December. Welcome to our co-hosts, Jeff McCarty, VP of Hedging and Trading Product, as well as Alex Hebner, Hedge Account Manager on our desk and also our market specialist on the podcast. Welcome, gentlemen.
Happy Thanksgiving.
Happy Thanksgiving. So today we'll be talking, as always, some timely market topics, including the unemployment report coming up this week. We'll also get a little bit more into some cabinet appointments, some other current events, and even, talk, foreshadow some tariff discussion that we're going to carry into next week on the cast. And as always, we'll if you're an originator or a capital markets person or anyone who's really interested in what's going on in our industry and with interest rates and with the markets, definitely we want to keep you informed on what you need to be paying attention to. So we'll get into a lot of that today. And then we're going to, in the third segment, we're going to talk about loan limits. So you may have noticed that the new loan limits for next year came out last week. So we'll talk a little bit about, the history of, where these loan limit calculations came from, how they're rolled out timing wise on an annual basis. We'll talk about what happened last week with the new limits coming out and even get into some arguments for and against these loan limits that continue to rise and what some of the effects of that might be. But before we get into that, as you know, we have our summit coming up, which is our annual conference, which is going to happen February 3rd through the 5th at the Marriott Marquis in San Diego. Again, we've got some deals going on for registration right now, so please do check that out. We're having a Cyber Week deal running this week where you can get a discounted rate, and you just have to use a code when you register, and that code is CyberOBS25, all one word, CyberOBS25. So please do check that out. As you know, we're going to have some great sessions where we dig into things like, everyday operations of the business and secondary marketing and capital markets, but we're also going to get into some, overall strategy, with profitability and get into subjects like AI. And we're going to have some great speakers, some internal speakers, but also some folks from the outside. We will have the great Tony Hawk who's going to visit with us.
Yes. 8 more weeks that I get to be excited about getting to hear Tony Hawk. So we get to talk about it every week for the next eight or 9 weeks here.
That's right. Also, Mike Frattantoni from the MBA, chief economist at the MBA. So really interested in the wisdom that he has to drop on us in February. Some more announcements to come, but please check out the website and register. And with that, let's go check in with Alex.
All right. Welcome back, Alex.
Hey, Jeff. How's it going?
Good. So even with the holiday week last week, still felt like it was a relatively busy week between Fed minutes being released, some various economic numbers, and then, Trump making some appointment announcements to start his administration. So maybe walk us through some of the economic numbers that came out last week.
Yeah, definitely. Yeah, the week was pretty front loaded. Just anything that would have been released later in the week to account for the holiday, they released on Tuesday. So you saw a large number of data points coming out on Tuesday. Some of the big ones that I kind of wanted to draw attention to were consumer confidence, which came in right at expectations at a 111 release. So still showing that the American consumer is spending money and pretty confident in the economy. I think that's a little conflicting with a narrative that's kind of emerging about, a weakening in the consumer and specifically around holiday expectations and consumer spending going into the holidays. There was expectations of weak Black Friday spending. And a lot of deals you might have noticed started early this year. And that's when the deals are starting early, that means that companies are trying to get ahead of each other on securing your dollars. So that kind of just means that companies are expecting weaker sales. Some preliminary numbers, we're recording this the Monday after Black Friday, but some preliminary numbers that came out of like MasterCard and other credit services showed that spending was up, 3.5% year over year since last Black Friday. But given inflation, inflate away those dollars by 2 or 3%. And we're really only seeing maybe a 1% increase in raw spending on Black Friday. And then I think the other one, for our industry, new home sales last week, 610,000 realized. We were expecting closer to 750,000. And 610,000. That was the lowest release we've seen since 2022. That number did kind of come with some asterisks attached to it, caveating it with the fact that their home building in the South was still being impacted from those hurricanes that we saw in October.
The consumer spending, I mean, that's a great one to keep an eye on, Jim. I feel like you always watch that one along with just kind of credit card debt and just, what is the consumer doing? It is one of those leading or one of the first indicators we have, right? But it's still, I mean, it's not growing, but it's not weakening substantially, but I feel like we're waiting for the other shoe to drop there.
Yeah. I mean, it's Main Street, right? It's what drives the U.S. economy. I believe 60% ish of GDP is consumer spending. Right. And if we're in a mode now where we're hitting any kind of limit on that, whether it's because, wages are not climbing anymore or folks have borrowed, more money than ever, which we have on credit cards, or if, the job market is slowing down or if it's inflation or whatever, right. We could be getting into another cycle where that number starts to peak out and then we have to have some sort of correction.
Absolutely. Yeah. Like you said, 60% of the U.S. economy is consumer spending. And it's always good to keep an eye on, credit card debt, then any delinquencies we see in auto debt and home ownership mortgage debt. Those are definitely some leading indicators that folks are under pressure.
So, maybe part of the reason we're seeing, consumer spending not fall off considerably, at least, economy has been markets have been relatively stable post-election. I think going into the election, probably all of us were expecting more volatility than we've seen one way or another. And I think that's a result of, one, just, the manner in which Trump won, right? There hasn't been any sort of uncertainty surrounding who won, right? It's very clear that Trump did win. And then some of his appointments, particularly on the economic side, I think are giving some confidence to the market at this point.
Absolutely. Yeah. I think, like you said, the way that Trump won the election, winning both the popular vote and the Electoral College was just such an astounding, defeat of the Harris campaign that there was really no questioning the results of the election. I know, for this podcast, we were talking like, hey, should we record on that Friday? Are we going to know who won yet? And, we could have recorded that on Wednesday, that podcast on Wednesday. We knew by then. And bringing Trump in again for a second term was positive for markets. I think there would have been a similar result in the Harris campaign. I don't think either of those campaigns were really running on an anti-business platform of any sort. But then in the preceding weeks, we've seen Trump begin to suss out his cabinet that'll come in with him. Two of the big ones that came out in the past few weeks was getting Bessent in for the Treasury. He has a Wall Street background. He cut his teeth with George Soros and currency trading in London. So he's very pro-business. And then Howard Lutnick, who has history with Cantor Fitzgerald, was their CEO for a number of years at Commerce Secretary. And so I think the combination of those two has given the markets pretty great confidence that this will be a pro-business environment, at least for, the first half of the administration.
Yeah, we're seeing new highs in the market every day, right? So obviously, folks, there may have been some defensive plays before the election, just kind of hedging against what the fallout could have been from the election, now putting money back into the market, but also just seeing this new administration probably being, leaning towards being pretty business friendly. So, it seems like that just equities are going to continue being healthy from here.
Yeah, Bessent, I think, he comes from a typical kind of Republican background of deregulation and deficit, and keeping an eye on the deficit spending. So, those are two things that, always cause Wall Street to rally.
The one spot where there has been, a lot more regulation adjacent rhetoric is tariffs, of course, right? We'll get into that a lot more next week in detail and talk about how tariffs could impact various parts of the economy. But so far, again, Bessent's rhetoric is that he sees using tariffs, they'll use tariffs strategically, which certainly walks back some of the more, I guess I'll call them more brash comments from Trump on tariffs, right?
Definitely. Yeah. On the campaign trail, we saw Trump throwing out numbers like a flat 60% tariff on anything imported from China and 20% from anywhere else in the world. We've definitely seen that walked back. One, Bessent, in his comments on tariffs, he said to apply them gradually, not to slap on a flat 60% tariff in any regard. And outside of just the personalities that we've seen, I've also seen some reporting from Reuters specifically that the Trump administration seems open to negotiation on tariffs in exchange for help in other regions. The one that I saw notated in this article was in his discussions with Mexico and China for their help in combating the fentanyl opioid crisis and those drugs coming into the States, that they could see relief on tariffs if they were able to show material gains in helping with that issue.
And Jim, you made the point, I think Jim, you and Alex made the point that there's been tariffs in place through, both the previous administrations too, right? So certainly tariffs used as policy is nothing new in the recent past. So, as long as that continues and doesn't get, too much more extreme, probably again, good for markets.
Yeah. I mean, there's precedent now, recent precedent, like you said, with the Harris-Biden administration did allow the Trump era tariffs to continue. And those didn't seem to cause any major issues for markets. There's definitely was some hyperbole, as you said, Alex, during the election a couple of months ago, but I think that's being reined in quite a bit. And the cabinet is looking to use tariffs strategically and kind of layer them in where it makes sense rather than try to shock the system and cause side effects like inflation, like the things you would worry about with new taxes.
Well, we'll get into that a lot more next week as well. So looking forward this week, we've got big monthly employment numbers at the end of the week. What else we got going on, Alex?
Yeah, this morning we saw construction spending surprise the upside, up 0.4%. It was expected in at 0.2%. It was depressed for all of this year until last month's release. We were seeing negative releases on construction spending, meaning that there was a contraction in new construction throughout the economy. And I think it's a good sign that construction spending is increasing month over month. We're back to, with this release, we're back to levels that we saw in 2023. So I think that is tally you can put in the continued strength of the economy category. But I think the biggest release for this week is the unemployment numbers. We'll get ADP on Wednesday, as we always do, and then followed by the non-farm number on Friday from the Bureau of Labor Statistics. I think that the non-farm one is definitely the one, at least on our desk, that we keep a closer eye on. ADP Wednesday, though, expected to be 80,000 lower than last month. Last month for non-farm was the big surprise. We only saw 12,000, and I remember we made comments, on the podcast back then about 12,000. What's 12,000 jobs in the grand scheme of things? That is, if you're one of those 12,000, it's a big deal for you. But in the grand scheme of things, very little change throughout the economy in regards to job numbers. They're expecting 200,000 this time around. I want to say we're going to have a miss there. It kind of seems like they're doubling down after missing last month. And I think, I just said construction spending, maybe tally one up for strong economy. Employment seems a little bit iffy. We've seen unemployment ticking up all year long. We're sitting over 4% for economy-wide unemployment now. Over the course of the year, we've seen about 600, 700,000, up to maybe like 750,000 new unemployed folks throughout the economy. So that's the number that I would keep an eye on, is just continued unemployment ticking up. Some of the sectors that have been hit most hard have been kind of the professional white collar sector, education and healthcare. They've seen the greatest rises in job loss this year, just from a pure number standpoint. They make up over 50%. Those sectors make up over 50% of that 750,000 that I was talking about. And then, we've also seen some contractions in like hospitality, leisure, construction itself. I know construction spending went up, but we have seen a contraction in construction employment and then manufacturing. And I don't think manufacturing should shock anyone when you look at just manufacturing sentiment numbers and manufacturing spending that comes out throughout the month. But there have been some improvements, not enough to make up for those white collar and healthcare related job losses, but mining, agriculture, and certain financial and IT services have seen some gains there. So yeah, we'll have to keep an eye on that non-farm number on Friday. That's kind of my number one metric at this point. Inflation is quote unquote tackled per Jerome Powell, or they're happy with where it's at. So it's time to turn the page and start looking at that second mandate for the Federal Reserve and keep an eye on unemployment and how fast they're going to have to cut. This will be the last unemployment number before the final FOMC meeting of the year. That one's on December 18th, just before we really get into the holidays and kind of the economy not really shutting down, but a lot of people taking time off to spend with their families during the holidays. Still leaning towards a 25 basis point cut there. It was about 2/3 of forward contracts right now are showing a cut is expected for this December meeting. So that would leave us going into the new year with a target rate of 4 to 25 basis points.
All right, good. Yeah, I think I like your points on the unemployment numbers. You have to look at the details. You can't put much stock in just 1 month's number, right? The number does fluctuate quite a bit. There's also been a ton of revisions over the past year, and the jobs do seem to be coming from certain sectors right now. And if you are in a white collar position, for instance, the unemployment numbers aren't very good, but there's other areas where the economy looks really strong. And I think there's just some details to pay attention to there. It's hard to make a big deal out of a single headline number in 1 month.
Absolutely. Well, perfect, Jeff. I want to throw it over to you real quick on a topic that is pretty pertinent to our industry and the listenership of this podcast. I want to carve out a little bit of time to talk about that. And that's the FHFA loan limits. They released the 2025 schedule last week, as they do at the last week in November each year. So you could just tell me a little bit about how those numbers are looking for next year.
Yeah, so numbers increased to $806,500. So an increase of almost $40,000 or 5.2%. So that's the standard loan limits. And then the high cost area loan limits increased to $1,209,750. That is 150%. That number is 150% of the standard loan limit, right? So that's the formula that they use to set the high val areas, just as a reminder there. And so, those are the headline numbers. Getting into a little bit more detail, we kind of wanted to review where do these numbers come from exactly? What's been some of the historical numbers in the past? Why are they set the way they are? And, some of maybe the pros and cons about the system we have set up at this point. Most people know that the FHFA is the one that sets these conforming loan limits for Fannie and Freddie. It's based on the Housing and Economic Recovery Act of 2008, right? So coming out of the housing crisis, they explicitly came up with this formula to set these numbers. At a high level, it's just reflecting changes in the average home price. All right, so I'm going to read this off so I get this exactly right. But the FHFA uses the nominal, seasonally adjusted, expanded data home price index to calculate the proportional change between the third quarter in 2023 and third quarter in 2024. So basically, that just means they're using their official HPI at the end of the third quarter in each year to figure out what the loan limits for the following year. And so, basically at the end of September, they start calculating that HPI, and then they know exactly what it will be for the following year. So it's a hard formula that they're using at this point. And we'll get into this a little bit later because it's at the end of the third quarter. That's why you start to see some aggregators, quote, guess what the new loan limits will be. But because it's that hard formula, they can essentially know exactly what it will be once they know those HPI numbers.
Right. It's always interesting how the aggregators try and get a jumpstart on the new conforming loan limits. And like you said, if they're using the same information as the government is, they're likely able to back into a number that's right around where it's going to land. Could you kind of walk me through why the aggregators might be looking to get a jump start? I mean, these numbers are going to come into effect until January 1st.
Yeah. The adoption timeline is something that's important here. So if we kind of walk back from the January 1st to when they take effect, all the way back, and this comes into play with really any type of announcement from the FHFA. So, what the FHFA does is they say these, in this example, the loan limits take effect for any loan funded through the agency cash window or any mortgage-backed security issued after January 1st. So that means these loans starting January 1st, these are closed loans, right? These are good loans that have closed, funded to the borrower, are already being securitized. And so if we start walking that back, of course, you've got, a delay between when the loan is securitized and when, or sold through the cash window and when the loan funds, right? So you're talking anywhere from, 15, 30, even more days there. And then you've got the timeline between when the loan funds and when the loan has locked with the borrower, right? So you're talking another 45, 60 days there. So, we got these new loan limit announcements at the end of November, but practically loans that are going to be securitized on January 1st have already been locked with the borrower. And certainly you've already been having discussions with the borrower, way back into, you're talking about August, September, even longer for long-term locks of when these loans kind of started their life, even before they were locked. And so, really it's kind of a tight window, this 1 month timeline between when the loan limits get announced and when they actually take effect. And so, aggregators, of course, they could easily be locking loans much later in the process. So if they can guess it, they can start locking those higher balance loans, knowing they're going to be under the conforming loan limit once they actually sell them to the agencies or once they actually securitize them.
Right. So the punchline is they just want to have that small window of being extra competitive or having an edge or having a niche.
Mm-hmm. Yep.
Yeah.
And that's, again, I think this is kind of interesting. It's something that always comes into play, right? We saw it a bunch with some of the new LLPAs, some of these AMI LLPA waivers over the past couple of years, a bunch of different things that the FHFA and then the GSEs have announced. It's hard to kind of fit them into this timeline of, this discrepancy of borrower lock and then when it actually gets sold to the agencies or when it actually gets securitized.
Mm-hmm.
But getting back in a little bit more on kind of the history of these loan limits, Jim, you're the old guy in the room. Maybe you can talk to us about what these used to look like back in the day.
Yeah, I mean, so you go back to the great financial crisis, or right about then, and I think a lot of us who were in the industry then, we remember the limit was 417,000 for most areas, and it was that way for many years until 2016, till the point where the calculation based on home prices actually caused that number to rise over 417, right? Because there was just basically the housing market was depressed for a very long time, if you recall. But since then, those numbers have increased substantially every year, especially during the pandemic, right? When rates were at all-time lows, 2021, 22, 23, we saw, 100,000 increase in 1 year. We saw an 80,000 increase 22 to 23. So really seen some dramatic changes in that number that the FHFA has put out there. And that's caused a little bit of, I'd say, not quite controversy yet, but there's some folks who would say those changes might be working against affordability, right? I mean, you can watch affordability plummet as these loan limits go up, and obviously correlation is not necessarily causation. It's not the limits going up that's directly affecting affordability, but an argument could be made that it's not helping affordability, right? It's helping people afford more and more expensive houses potentially. I mean, if you look at the limit this year, that's being announced for 25. It's close to a nice round number of just above $800,000, which at 80% LTV, right, with 20% down, that's $1 million house. So is the FHFA indirectly saying that that's about what a house should cost, $1 million, which I think some folks who are having in lower cost areas would say, no way, like that's not the kind of money that I'm prepared to spend or that my income supports. So there are some arguments against continuing to raise these limits, but for now, it's basically being run off of a formula, and it's essentially mandated for that number to increase as long as housing prices are increasing year over year. So that is affecting affordability.
Yeah, our friend of the podcast, Chris Maloney, has put some commentary out on this. He kind of was conjecturing if the FHFA director had any sort of discretion to actually go against the formula. I think he concluded that maybe there could be limited discretion where the director could overrule the formula, but essentially it is that would cause so much controversy on its own. So probably requires strong justification or even legislative changes to go against the formula for now.
Yes,
the loan limits are close to doubling in an 8-year period, right? 417 for a really long time, now up to 806, almost doubling. We've got this affordability issue. The FHFA and the agencies are trying to do a lot to promote first-time home buyers. When it is so easy to get a very expensive home for most people. You've kind of got this very much this on the one hand, on the other hand, and are these things working against each other?
Yeah, and as far as additional issues that I think can generally be caused by these limits continuing to increase and just the ease of borrowing using GSE loans or FHA or VA loans is it crowds out the private capital that previous to the great financial crisis was a major player in mortgages. And even this rhetoric has died down a little bit the last few years, but after the financial crisis, Congress wanted private capital to come back, and they wanted them to come back in a huge way. Like more than 50% of mortgages, Congress wanted to be backed by private money, and there's just been no opportunity or no avenue for private money to come back into the market because the GSE and FHA financing programs are so low cost and so competitive.
Yeah, we've been talking about this for as long as I can remember, certainly, and we saw maybe a little bit of it a couple of years ago when rates were low and a lot of banks were looking for yield outside of treasuries. When treasury rates were so low, they're able to get a little bit more yield in mortgages, but beyond that, there's really been no meaningful, what I would call meaningful inroads. Certainly nowhere approaching the 50% number you mentioned. Nowhere close.
It's been more, banks, credit unions, buying loans or acquiring loans for their own portfolio, but there's been very little securitization of those loans, right? So there's been very little capitalization from the secondary market.
On the other hand, certainly these loan limits, I think, are one of the tools that have provided a lot of stability to our market. For everybody listening to the market, I think everybody's, that's to a certain degree appreciate the stability that we have had. And I think these are one of the tools that have provided that stability. So,
one of a kind in the world.
Yeah, absolutely.
There's no other part of the world where you can get a 30-year fixed mortgage, period, with the kind of rates that you see in this country. So there's certainly a reason that the GSEs exist, and a big reason was to create stability and affordability.
Yep. All right. So to wrap it up, the announcement of the new loan limits came out last week. Most rate sheets, most pricing engines probably have already incorporated these. If not, they will certainly be doing so in the next several days. So certainly, at this point, probably able to take advantage of those higher loan limits, although, a more modest increase than we've seen the past several years. Still a decent little jump here, 5% jump. Certainly might open up a few more opportunities.
All right. Great conversation for our listeners today. Appreciate that. Thank you, Jeff. Thank you, Alex. Let's wrap this podcast up. Please do make sure you register for the summit. Pay attention to the unemployment report. Comes out this Friday, 8:30 Eastern time. And as promised, next week, we're going to have some pretty in-depth discussion about tariffs. Just what are they? What's the history of them? How might tariffs affect the market? Should be a super lively discussion. So tune in for that. And that's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Don't forget to follow us on LinkedIn for more updates and to access our latest video episodes. You can also find each episode on all major podcast platforms. Thanks again for tuning into Optimal Insights.
Be part of an event that will shape mortgage innovation and lender profitability. This client-exclusive event will feature sessions exploring AI trends, profitability strategies, market insights, and more. Plan to attend the Optimal Blue Summit from February 3rd to 5th, 2025 at the Marriott Marquis San Diego Marina. Don't miss your chance to shape the future of mortgage technology. Register now at summit.optimalblue.com.